following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
All right, let's talk futures. Joining me live, the very handsome Bobby Iaccino. Bob, good morning.
Oh, what's up, Jimmy?
I love the I just love the shirt. I do.
Yeah, it makes me uncomfortable, but it is what it is. I was telling you guys in the back there that I've got two Fox News spots today. One is Fox Business News and one is Fox News. And I'm usually on with you guys on Wednesday. So it's easier for me just to not change my shirt because Fox doesn't like the t-shirt or the tattoos, believe it or not. Even though Fox is all about individual rights, they don't want me to show my tattoos.
Yeah.
Whatever.
Anyway, I got to get some of those. I turned 60, Bobby, and my wife finally gave me permission to get tattoos. She goes, at this point, okay.
That all makes me really happy.
Yeah, there we go. Anyway, so let's start out. CPI hit the street today, and by some accounts, it was a Goldilocks print.
There's a question in there, right? You're saying, is it or isn't it? And I would say,
yeah.
I would say that if you're looking at it in a vacuum, it is. I mean, you've got the month over month. I believe, don't quote me on this, it might have been the core, but you've got 2 consecutive months in that data on the month over month basis negative.
Yeah.
So that's good. That's the first sign we have of prices actually coming down. Okay, I've been saying this forever to anyone who will listen. Inflation has not been coming down. Okay, it's been rising more slowly. Now, you want this to happen consistently, but the problem is, if you get this consistently, you talk about the FOMC and the Fed watch tool that the CME group puts out.
Yeah.
They're now at 6 rate cuts priced in through 2025. And I think the last I looked, I probably still have it up here somewhere.
We've heard that song before.
Yeah, right after the May 2023 meeting, they priced in 7 rate cuts, with 6 of them being this year. Yeah. Right now, we've got a 93% probability of no change in July and an 83% probability of a cut in September. And then we've got 5 more cuts all the way through July of next year. Now, obviously, the probability progressively goes lower, but that's more, I think, a time decay thing, sort of like, you're pricing in the value of time in that. So, I mean, obviously, a lot can change in that period of time, but the market now believes that the Fed's going on a rate cut cycle. All right. And if you're going on a rate cut cycle, this is a be careful what you wish for kind of a thing. Because if you're wishing for a rate cut cycle, you're wishing for a dramatic slowdown in the economy. That's not good.
So let's talk about cycles for a second. I mean, a lot of folks are old enough now to see sometimes, we get cuts and we approach zero. A lot of the chatter now is like, all right, we're going to be in this cycle, but probably get to a natural 4% Fed funds rate and then stop instead of going all the way to zero. That seems to be the sentiment from the talking heads.
Yeah, but I mean, I'm not sure that's what matters, right? I mean, if we go to 4%, fine. Why 4%, right? There's going to be a lot of data between now and then, a lot. And you're familiar with the SOM rule, right?
Yeah.
Okay, so basically the SOM rule has not triggered yet, but maybe after today it will. And there has never been a recession I'm sorry, there's never been a SOM rule trigger that didn't lead to recession. If you look at it in arrears, it's the most consistent indicator of whether there's going to be a recession or not. And like I said, if we go into a rate cut cycle, you could put that rate wherever you want to put it. If we end up in a recession, if we end up with a lot of slowing, okay, that's not a good thing, is basically what I'm trying to say.
So, but is that an argument to keep rates higher for longer?
It's an argument. No, it's not, because it really ends up being an argument to cut rates a little bit quicker, right? To try and make sure that the market doesn't go into a recession. But the problem is you then trigger inflation fears. You know, we're talking about inflation finally dropping, right? But the reality is the only thing that's going to have inflation dropping consistently is if consumers slow their spending. We're a consumer-driven economy. So you need consumers. I hate to say it because it sounds very negative toward individual. I'm not. I'm a little bit of a humanist. I want people to do better, right? But you need consumers to feel it so they stop spending. And if you give them dramatic rate cuts, so one of the things that's happening right now is in October of 2022, all right, revolving debt, so it means credit cards and any other piece of revolving debt you may have from a bank, home equity loan, line of credit, whatever, to individual consumers in October of 2022 reached the highest level in about 11 years. That's as a percentage of disposable income. Then wages started rising, and that percentage of disposable income started to drop. We're moving in the other direction now. It's starting to rise again. We're not past that October of 2022 peak, but we're headed in that direction. Credit card debt is at an all-time high, but that's more a sign of a strong economy, consumer spending, stronger wages, people are comfortable. What you want to look at is that percentage of disposable income number, because who cares if credit cards are debts moving in an all-time high? People can pay those debts, right? But delinquencies are rising. And the delinquencies now are at the highest level since 2012. So there are cracks with the consumer. And if you kind of just left rates here for a while, you might have a consistent drop in the rate of change on inflation. You might have more negative month over month numbers. So what you don't want to see, in my view, is a rate cut cycle, because now you're giving extra sort of rocket fuel to the consumer by lowering rates on their revolving debt and lowering rates maybe on new car loans that they might not have yet gotten into. If you saw in the CPI data, new cars were down slightly, used cars were down over 1% in terms of the prices. Shelter costs were down. Now you want to cut interest rates that consumers are paying. That potentially could spark inflation again, and then you run the risk of the Fed needing to go in the other direction really quick. Nothing is worse than a manic Fed. And a manic Fed comes when, oh crap, the economy is slowing and inflation is ramping back up. And those two things together are the worst possible scenario for asset prices.
Okay. Well, so right now, from a portfolio point of view, S&P, NASDAQ, even the Dow and the Russell starting to peak up a little bit. At least the S&P and NASDAQ, they don't care that we're stuck at a 5.31 effective Fed funds rate.
Well, I don't know if I agree with that, and it's only for one reason. I don't look at volume every day, but I look at volume in times like this, right? Where the market's going up, no matter what the result is, right? And if you look, for example, I'm looking at S&P futures. Volume has been dropping, not on a day-to-day basis, but on an absolute level. So over this 6-day winning streak that we had in the S&P futures, the start of the winning streak versus yesterday, let's say. Yesterday, we ended up with a little less than 75% of the volume of the day that started this winning streak. Now, did we have a drop in volume every single day? No. As a matter of fact, the last 3 days, volumes has been rising. But today, we got a really good start on volume, and we're down 0.25% in the S&P. So we're not getting confirmation from the broader market yet. Now, I will point to the one bright spot. The Russell is killing it. And that to me is the most important thing that we're seeing today. Okay, the Russell is killing it. The Russell should react this way. I mean, I'm seeing Russell futures up over 3% right now. I don't know exactly where it is. All right. You want to see Russell strength if you believe that the rate cut thing is a good thing for equities. You want to see the Russell catching up. The Russell's been above the 200-day moving average for a while, but has not caught up to the NASDAQ or the S&P. To me, the Russell represents market breadth, right? It doesn't technically represent that, but historically, other than say the past 5 or 6 years, small caps outperform large caps. Now that may never be the case again because of the Magnificent Seven and AI and everything else. But I want to see the Russell catch up because to me, that's a healthy market. And today we're getting that. Here's the negative thing we're seeing today. Higher gold prices, higher silver prices, not by small amounts, and lower copper prices and lower crude oil prices. What does that say to you?
Yeah,
It says to me the potential for more inflation and a slowing economy.
Yeah, I hear you. So, but going back to, let's just kind of go back a little bit to revolving and non-revolving debt as it relates to the money supply, right? Fed, every month they release the money supply, particularly the M2 number. Is there still just a ton of money flowing out into the economy right now?
Well, if you look, I mean, you've got that up, right? M2 did come off its highs.
Yeah, I do have a chart. Let's go ahead and pull that up.
Yeah, if you zoom in on that a little bit to the more recent data, say starting with just before the COVID recession that's marked off on this chart, right?
Yeah.
And you go to now, you'll see that obviously we shot up during COVID and it continued to shoot up, right? And then we started tapering off. We got a little bit of a spike recently, then a drop. Now it looks like we're seeing a little bit of a move higher again, right? My opinion, you don't want to see this. Go ahead.
Well, no, I'll zoom in some more, but I just kind of wanted to do like a real rough regression line kind of thing, just to see if we're, this is, so I'm a little bit before before COVID. And so this line's kind of, and if you go all the way back to 1981 or whatever, it's a nicely fitting line. And so here we leapfrog to another level, right? Another level here, and we're not back to trend yet.
Right. One of the things you might want to look at, and the only reason I'm bringing this up is, so M2 includes basically all money, right? Currency in circulation, checkable deposits, savings deposits, money market securities, mutual funds. Take a look at M3.
All right, I could probably pull that up pretty easy. Let me do it on another browser, though. You're
still going to be looking at it as, what do you call it? From the St. Louis Fed, right?
Yeah.
If
broad
you look
money
at that,
components, here we go.
Yeah, so M3, and I'm not saying you guys should start looking at M3 as a trading barometer at all. But what I am saying is there's been no drop in M3. And if you draw that same mean reversion line when you're able to get it up, there's been no movement there. And so M3 includes everything in M2, as well as larger and more liquid assets, or I'm sorry, less liquid assets. So think homes, think institutional money funds, think repo, think mutual funds that have a lock, things like that, things that are less liquid, right? And you'll see that that has been straight up. So what does that mean? Well, it means that on a larger scale, people still feel richer than they used to feel, right? They still feel richer than they used to feel. It really didn't drop at all. We got a very brief drop here, but then it just started to stay flat and looks like it's ready to ramp up as well. So by most measures, money supply is not shrinking, which to me means the Fed has not been restrictive, right? And we know that because we know that housing supply has not increased. So obviously M3 includes homes, right? Less liquid assets and the value of those homes. So you're looking at a situation where we have not seen restrictive behavior from this particular set of interest rates. So what's going to happen if we're at interest rates that are not really restrictive, despite what Jerome Powell says, and he cuts those now? We're going to have more, I should say, even less restrictive policy. So the thing that worries me most is a resumption in inflation. I was looking at the Citigroup Surprise Index, and that thing is negative and has been negative. So what does that mean? It means economic data has been surprising to the downside for quite some time. It's recovered a little bit, but it means that the economy is slowing down if you use that as your only barometer. Now, I also look at manufacturing PMI because it's, yes, we're a services economy, but manufacturing PMI still relates to the business cycle very well. And manufacturing PMI has been very strong relative to where it had been. It's not very strong. It's not a really good number, but on a rate of change basis, it's been strong. So one of these two is going to give, right? Either the data that we're seeing that is showing a slowdown is going to turn around, or manufacturing PMI is going to turn around. And I think that's one of the things that the Fed might fear. They might fear an economic downturn with inflation still at 3%, which is where it is. That's why I think they want to start cutting so badly. This is a Fed that wants to cut. They've made that very clear, if not in the last meeting and press conference, in the statement and press conference, then in the, we used to call it Humphrey Hawkins, I still call it Humphrey Hawkins, then the semi-annual testimony before Congress, which is Humphrey Hawkins. That's where we're seeing it the most to me. Some people say he was hawkish there. I don't agree at all. I think he put zero hurdles in front of a September. I think we're getting that September rate cut.
Got it. All right. Well, we'll see. Certainly, if you go by the Fed funds tool, it's suggesting that's going to be the case. There's a lot of people suggesting, hey, we got to do it now. What is the, if we don't want to be too late, and cause this giant recession that everyone, it's a 50-50 proposition depending on who you're listening to. So
let's look at it this way. And this is my take only. What might people have FOMO about right now? I would say it would be the AI trade. That would be the thing that people have FOMO about. So what is going to stop people from buying any dip in tech stocks if we get it? I say nothing. Right. So even if we get a correction, Mike Wilson from Morgan Stanley is calling for a 10% correction to start probably by the end of this year, otherwise early 2025. What's to stop people from buying the correction? I think virtually nothing. Virtually nothing is going to stop them from buying that. Simply because there's going to be a lot of cash on the sidelines. And by the way, if you own any sort of retirement fund at all, you own AI. Okay. You own NVIDIA, you own Broadcom, you own something. If you own any sort of long only, own something.
It could be.
But basically at the end of the day, dips are likely to be bought even if we get that 10% correction, especially if the Fed is cutting. So what changes that? A recession. Because that means that other assets are falling so quickly that people have to aggressively sell winners to raise cash. That's the only thing that's going to bring about, in my view, a 20% or a 25% downdraft in stocks. But that is not the only thing that's going to cause gold to move higher, or crude oil to move higher, or silver to move higher.
So, but all right. So I know we're getting close. We're getting close to the end of the session today. I don't want to make you late, but so boom, we're heading toward recession. If that happens, then going back to money supply, does quantitative easing kick back in?
I think it does. I think that's the first thing that's going to happen, whether they announce it or not. And they already kind of did. at the last meeting. Go read the FOMC minutes, and they're slowing the purchase of balance sheet erosion. Right? They already said that. I'm sorry, they're slowing the process of balance sheet erosion. So they're not going to call it QE because they're not buying new bonds. They're just going to stop letting the bonds they already own expire. And they're going to start replacing them with current bonds. So things that age out, right? If you had a 2-year note from 2 years ago, it matures, and they're going to replace those. So you're really talking about semantics here, because you're talking about them replacing things. They have to go into the market and buy those to replace them.
Right. But that's different than tapering, right? Tapering is we're going to let them roll off and they're gone forever.
Right. Right. And that's something that they were doing, but they said they're going to slow the pace of that. Right. So they're still going to let some things expire. I suspect they're going to let the longer term stuff expire so that longer term rates can move a little higher. And they're going to continue to replace the 3-month, the 2-year, the 5-year, and some of the mortgage backs in order to keep those rates lower and try and get the yield curve to the right shape again.
Yeah, it makes
which will
sense.
help banks, which will help lending, right?
Yeah. Well, let me squeeze this in. We have we had a 10-year auction yesterday that, only 1.16% went off at the high bid, which was probably pretty good. Yeah. And then a 30-year auction today. I'm wondering how that's going to go.
I would think that would probably go average to poorly, simply because, again, rates have been falling, and I wouldn't suspect you'd want to buy these at the rate they're going to be set at. I just think it's likely to go poorly or average. I don't think it's going to go spectacular at all.
Okay. Well, we'll see. We're data dependent, just like the Fed on that one. We'll get it in a couple of minutes. All right. I know you got to scoot in a couple of minutes here. What's the best way for people to reach out to you? You publish a lot of stuff everywhere for free. That's awesome stuff. Yeah.
We've got our podcast, The Future's Edge, that comes out every Monday, and it comes out on Twitter in its entirety on X. So you could find me there, Bob_Iaccino, or it's on every podcast platform that you could find. We also now have a YouTube and a Rumble channel, which we didn't have before, whichever one you decide is better for you. So if you guys can, it'd be great if you'd subscribe to either or both, if those are platforms you use a lot. But otherwise, every podcast platform. And then you could follow me on Twitter as well. It's Bob_Iaccino. It's X now, but let's just call it Twitter so everybody knows what the hell I'm talking about. And if you reach out to me on there, I'll generally respond if I'm not buried.
Awesome. Well, that's great. It's good stuff. You're keeping me in shape because I'm on the Stairmaster when I listen to you. It helps the 30 minutes go by. It's awesome.
Always happy to help, buddy.
Yeah, so that sounds good. So anyway, next time maybe we'll talk a little bit about housing prices. And I had another question for you, but we don't have time. We'll talk about this home price record high for 9th straight week by Redfin. We'll get into that next time, Bobby. But let me
throw something in on that really, really quick.
Yeah.
Shelter has not come down enough, or rates have not come down enough for existing home sales to increase. We don't have enough supply of old homes for people to buy. So they all go to new homes, which keep those prices elevated. But we could talk more about that in the next show. Oh,
that makes sense. Yeah. Interest rates are still relatively high.
Yeah. Rates need to come down. We've had mortgages drop down a little bit, but they're still above 6 3/4, near that 7% level. That doesn't convince people to get out of their 3% mortgage that they're locked into.
Yeah. Yeah, totally makes sense. All right, Bobby, again, thanks again. I know you got to roll. Appreciate you being here. Looking forward to seeing you next time.
Good to see you guys.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.